Okay, yeah, we have exam start question. Shani's financial year ends on 31st of May. She maintains a provision for doubtful debts at 4% on the trade receivables, which is that's the current asset, right? At the end of each financial year, on 1 June 22, Shani's provision was $480. On 31st of May 23, her trade receivables amounted to $10,800. So that means for 23 year end, the trade receivable is $10,800. But this is for 22. 480 was for 22. So for 23, it will be 4% of 10,800. So we have 4%. 4 divided, that's 0.04. 0.04 times 10,800. So we have 432. So that means the provision for doubtful debt is 432. So where are we going to post it? Is it going to be the debit side or the credit side? For provision for doubtful debt, it is an account receivable. That means that account it is the account that will pay into the income statement. Do you understand? We've prepared this account, the provision for doubtful debt. The amount is there. So this amount will be paid into our income statement in case the debt goes bad. Do you understand? So provision for doubtful debt is a receivable account. So which means it's going to have a credit balance. So that means our provision for doubtful debt will have a credit balance of 432, and the income statement for 23 will be 432. Is it clear? Alright, so B is the answer. Then 2. Here they said Shahil's financial year ends on 31st of March. On 1 April 27, he purchased furniture costing 4,400. That's the cost value of the furniture, which is an asset, for use in the office. He decided to depreciate the furniture using the reducing balance method at 15% per annum. So the question now says, which journal entry did Shahil make on 31st of March 29? That means this is 27. So when you are making provision for depreciation, you don't count from the year you purchased the asset. You start from the second year of purchasing the asset. So we need to use reducing balance method for 28 and 29. Great. So for 28, since it is 15% on depreciation, right, per annum. So for year 1, 28. So the cost of the asset, 4,400, multiplied by 15%, which is 0.15. It gives us 660. So 660 is the provision for depreciation for 28. Then 660, because we are using reducing balance method, so the provision for depreciation for this year minus the cost of the assets. So 660 minus 4,400 minus 660 gives us 4,400 minus 660 gives 3,740. So 3,740 multiplied by 0.15. So the provision for depreciation for 29 is 561. So the answer is A. Our income statement we have 561. The provision for depreciation we have 561. Okay. Is it clear? Yeah. Heather. We have question 3. Jenny owns a retail store. Her financial year ends on 31 July. On 31 July 21, Jenny purchased stationery $112 on credit from AB Supplies. Jenny took goods costing $130 for personal use. Jenny depreciated her shop fittings by $180. Prepare a journal entry to record those items. Narratives are required. So we need to prepare a journal entry for Jenny. The format, the date, details, folio, debit, and credit entry. So it should be 31st of July because that's the end of the accounting year or the financial year. So the first transaction, Jenny purchased stationery $112. So from AB Supplies. So stationery account have a debit balance because stationery account received from AB Supplies. So stationery $112 on the debit side. Then AB Supplies will be credited, right? A credit balance. AB Supplies $112. The analysis of the account or the narrative will be purchases of stationery on credit. I think it's clear. Second transaction. Jenny took goods costing $130 for personal use. That's drawings. And remember, when you take goods in the income statement, you less it from your purchases. So drawings, $130 will be debited because drawings account received the goods. The income statement will have the credit balance because you have to take it away in the income statement, trading section. Then the analysis or the narrative will be transfer to income statement of goods for personal use. Then the third transaction, Jenny depreciated her shop fittings by $180. So the income statement will have depreciation, provision for depreciation, which is $180. What was depreciated will have the credit balance, which is the shop fittings. So depreciation of shop fittings, 180, which will be a credit balance. Then the annual depreciation charge transferred to the income statement will be the narrative. Is it clear?
Yes.
Then the second question says, on 31 July 21, the balance in Jenny's ledger included the following: rent, 3,120, sales, 95,600, purchases returns, 1,720. 1/4 of the rent relates to Jenny's apartment above the shop. So that means the total rent is 3,120, but Jenny's apartment is taking 1/4 of that amount. So what are you going to record as in the income statement? The 1/4 of this minus the actual value of the rent. So let's prepare the journal. They said prepare journal entries to adjust the rent and record the year transfers to the income statement for the 3 accounts. Narratives are required. For the 3 accounts, narratives are required. So we open the journal entry. Date, details, folio, debit, and the credit entry. The first transaction, the first item, rent, 3,120. So the income statement will have 1/4 of 3,001 of the actual cost minus the actual cost. So that means 3,120. This will be in the front anyway. 3,120 minus 1/4 of 3,120. So it gives us 2,340. So the income statement will receive 2,000. Will have a debit balance of 2,340. Then the rent will have 2,340. Is it clear? Yes. Then the narrative or the analysis will be transfer of rent for the year to the income statement. Then the second item, sales. Sales is supposed to be a credit balance, right? Do you understand? But here, because we are preparing a journal, so you have it at the debit side here, then your income in the income statement, sales will be a credit balance in the income statement. Purchases will be a debit balance in the income statement. So when you are preparing a journal, purchases will be a credit balance in your journal. The income statement will be the debit balance. Do you understand? So for sales, your debit balance will be sales. Then the income statement will have the credit balance. Do you understand? Then the transfer of sales for the year to the income statement, 95,600. Then the last one, purchases returns. Purchases, that means your customer return, that's return inward. Return inward is a debit entry in your income statement. So in your journal, it will be what? A credit entry. Do you understand? Yes. So purchases returns, because purchases is also, if we are preparing a journal here, purchases will be a credit entry. So since purchases will be a credit entry, then purchases returns will be a debit entry. Since sales returns will be a credit entry, then sales will be a debit entry. So here, purchases returns 1,720, which is the same as return inward, right? Return inward. So purchases returns 1,720. The income statement will have 1,720. Then the analysis or the narrative will be transfer of purchases returns for the year to the income statement. Is it clear? I think you understand how to open the journal entries now. Yes. Okay. Then Adam, we have this question. Question 4. It said, Lindewa discovered that goods sold on credit to Zach, $260, had been incorrectly credited to Zachari's account. Which journal entry corrects this error? So there's an error here. So Zach was to be credited, but Zachari's account was credited. That's error of commission. It does not affect the trial balance, or does it? The trial balance will balance because it's an error of commission. So it doesn't affect the trial balance. So here they say suspense account. It's not going to even have a suspense account because it is only errors that affect the trial balance that have a suspense account. So that means suspense account is out of it. A is out of it. B, it has a suspense account, so it's out of it too. Now we check C and D. Zachary was credited. Yeah. So to correct the error, you have to debit Zachary. and credit Zach. So Zachary was debited, Zach has been credited. Here Zach debited, Zachary credited. So Zachary cannot be credited again. To correct this error, to correct an error of a credit entry, you have to debit entry. Then to correct an error of a debit entry, you have to correct to credit entry. So the answer is C. Zachary has to be debited because he has been credited. So Zachary has to be credited, then Zach has to be credited. So the answer is C. Is it clear?